So stocks are down almost 3 months in a row, and the stock market is now officially in a correction. So what's going on here? And does this mean that the year-end rally is dead? Let's find out in this video. So I can see that more and more investors are beginning to start panicking, especially the last few days. It looks like the market is going down relentlessly. Even with companies, some of them announcing better than expected earnings, the price pops at first and then drops back down again. And again, we are now in almost the third month in a row of the market closing lower. So what the heck is happening? And what should we do as investors or as traders? And what can we expect moving forward? Now let's take a closer look at the charts right here. So this correction actually began somewhere in the middle of July, right? So middle of July, that was the high for the year. And from where we were, we are down about just closing at about 10% above the high. So this is known as a correction. So every time the market drops 10% or more from the high, that's known as a correction. When a market drops 20% or more, that's called a bear market. So for those of you who are wondering, is the bull market over? Is it in a bear market? No, it's not. Well, at least not for now. It's still in a correction. It's not in a bear market. Now, could a correction turn into a bear market? Sure, everything is possible. In fact, there's a 35% chance that any correction becomes a bear market. But for many reasons I'm going to explain later on, I highly doubt that we're going to go into another bear market. We had a bear market in 2020, another one in 2022. So to have another bear market this year is pretty unlikely, especially given the fact that we have got solid economic data recently. Company announcing earnings in Q3 have been much better than expected. We'll go through all that stuff. So my gut feel is that no, this is not another bear market. This is just a correction, and corrections are pretty common. And again, later on we'll take a look at some of the statistics. How long do corrections last? What's the average decline? And when can we expect a rebound, right? So again, for now, it looks like it's a correction within the bull market. So again, recall that we were in a bear market last year in 2022, right? So this was the bear market here, right? Wave up, wave down, wave up, wave down, wave up, wave down. So this was the bear market where we kind of like dropped about 27%, right? And then we made a bottom, the bear market bottom in October last year. And then we started this new bull market. So this is what the bull market trend looks like right here, right? This is the bull market trend. And again, remember that in a bull market, prices don't go up in a straight line, all right? They still go through ups and downs within that bull market. So you can see it's a wave up, and a wave down, a wave up, wave down. And then we had a very strong wave up all the way up here, again to the middle of July. And then in the last 3 months, we have now gone through a wave down. Okay, so right now we're at this wave down. And of course, the question is, are we at the bottom of this wave down, or could we go even lower, right? So I keep saying that, we can never know the exact bottom of a wave down, of a correction. No one can predict the exact bottom, but we can kind of like have educated guesses based on support levels. So if you take a look at the charts right here, you can see that there was a level of support here at this first dotted line, and we kind of like close below that first support. So that first support is really broken, right? So where are the next supports? So currently the market has closed right at this second level of support over here, right? So this is actually another level of support over here. Now, could this be the bottom, and could we bounce next week? Again, everything is possible. We don't know, right? But if we break this level, then the next level down would be somewhere here at about 3944. Now, this actually coincides with the 200 moving average on the weekly candles. Now, if you go back in history, the 200 weekly moving average is a very strong support. You can see it went down and bounced over there. And it bounced many times historically, right? So if we do break this support, then my guess would be we find support here and then we bounce back up, right? So I'm watching this level very, very carefully, yeah? But you never know. This could actually be near the current low of this correction. Now, if you play with a bit of Fibonacci, you can see that we are actually also at this level, we are at a 61.8% Fibonacci retracement level. So if I take out my Fibonacci tool, you can see that is the start of the wave A to B, right? So we have got the A to B wave, and then there we are. That's a 61.8% Fibonacci level right there, right there. Okay, so we are right there over here. Okay, so again, we could, right? If this level holds next week, especially with the Fed speaking and we've got some other data coming out, if that turns out to be better than expected, we could bounce there. But if we break this, yep, we could be seeing 3944 over here. So currently we are down 10% from the high, just 10%. And that's the definition of a correction. Okay, and if we drop down to this level, then we'll be down about close to 14-15%, which is also very possible, because I'll show you some data in a while that if you look at the average corrections historically, the average correction is actually 15%. Okay, so I think that a good guess would be that we bottom somewhere between here and here. Now, as an investor, always remember that high quality companies that are fundamentally good and the index will always go up. So don't worry about declines. They will happen. The market doesn't go up in a straight line. So historically, if you take a look at the last 72 years, there have been 34 declines of 10% or more. Now, out of the 34 declines, 12 of them turn into a bear market. So like I said, not every correction leads into a bear market. Only 35% of corrections lead into a bear market. So the chance that this becomes another bear market is 35%. But like I said, I think it's a lot lower than 35% for the fact that we've just seen 2 bear markets in the last 3 years. So another one is pretty unlikely. Also, again, because of very strong economic data and earnings data from the companies, which I'll again talk about more later on, right? So this is most probably a normal correction. And if you take a look at the last 72 years, there have been 22 corrections over that period. So roughly, you get a correction every 3.27 years. So if this is a correction, how long does it tend to last? How deep does it go? And how long does it take to bounce back? Now, if you take a look at all the corrections back to 1950, you can see that it takes an average of 132 days or 4 months to bottom. All right. And it takes another 4.5 months to get back to the all-time highs again. And the average decline of a correction is 15%. Now, this is since 1950, 72 years ago. But if you take a look at as time passes, you notice that corrections and bear markets are actually getting shorter and shorter and shorter because of the nature of markets, right? Markets move a lot faster, news moves a lot faster. So if you take a look at the last 30 years, which I think is more relevant, since 1993, you can see that the average correction took 96 days. Now, this current correction we're in is in the 91st day. So based on duration, we are pretty near the average time to bottom. However, you can see the average correction is one where the market drops 16%. Whereas right now, this correction, we're down 10%. So based on percentage decline, like I said, we could go down another 5% to that second support level, which I showed you early on. Now, I must say that this decline has been deeper and longer than I expected. So we all expected that August and September would be seasonally weaker months of the year, right? Seasonality, especially after a very strong first half of the year, the market tends to pull back. So that was pretty expected, but I didn't expect that the market would pull back for 3 months and down 10% from the high into a correction. So that really goes to show you that no one can predict exactly what's going to happen in the markets. Anything can happen in the market. So even when you have got seemingly good fundamental results, right? Recently, GDP came in stronger than expected. We have got strong job growth in the US economy. You got great earnings being reported, but despite all that, the market goes down. So that's why I keep telling my students that, remember, as an investor in the short term, the market is not always rational. The market doesn't always reflect the true value of companies. The market can be totally irrational, driven by sentiment and emotions and manipulation and all kinds of stuff, right? So as an investor, the most important thing is to focus on the underlying businesses behind the stock you own. Are the businesses doing well? Are they actually making more money? Are they increasing their intrinsic values? And if they are, then you should have no worries, right? And if the companies are doing well, but the share price still goes down, no point being upset, because you have zero control over where the market price goes. It's not within your control. So no point being worried or upset about something you can't control. The only thing you can control are the quality of the companies that you own. So like I said, if the company is doing well, but the price still goes down, you can do two things. Number one, either ignore the market price because it will rebound later once the market sentiment shifts, or take advantage of it and use that opportunity to buy more shares at a bigger discount of a great company that you own, or adding a new company that you want to own, but now you're getting a great deal owning it, right? Now, right now we're in the middle of the earnings season where companies have been announcing earnings. Recently, we have got Amazon announced, wow, fantastic earnings, better than expected. Meta also announced better than expected, but the stock price still went down, right? The market's mad, but I don't care. I could buy more Meta shares. I'm not worried at all because I know that Meta is doing really well. Same thing, Google reported better than expected results. Bastard still went down. It's fine, right? Microsoft announced better than expected results. Price went up a lot, but it came back down again, right? But it's still a bit higher than where it started off from. So for me as an investor, when I look at my portfolio companies, I'm very, very happy because they are doing really, really well. And not only that, if you take a look at the companies in the S&P 500 in aggregate during this quarter 3 earnings season, they are doing better than expected. So again, as an investor, when you think rationally and logically, you should have zero worries because companies are doing well. And that's another reason why I doubt that this correction will lead into a bear market. I think it's just a normal correction that's being used to shake out the weak hands before the market rallies back by the end of the year. Now, again, let's take a closer look at earnings and let's see what I'm talking about. Why do I think that it's not too bad, right? So far, we have got 78% of the S&P 500 companies that have announced earnings this quarter, or rather for the third quarter, right? But this period, right? 78% of the companies have beaten their earnings per share estimates given by analysts to date for quarter 3, which is above the 5-year average of 77% and above the 10-year average of 74%. So companies are surprising better than expected based on historical surprises. Now, what's also interesting is that, in fact, in the last 1, 2, 3 quarters, S&P 500 earnings have been negative. The growth has been negative. That's why we've been saying that this has actually been an earnings recession. So a lot of people have asked, how come there's no recession? Everyone expected a recession this year because of the inverted yield curve. How come there's no recession? Well, I've got news for you. Actually, there has been a recession. It's just that it's not been official. It's been a rolling recession where different industries go into recessions at different times. But it shows up in the earnings of the S&P 500 companies. So the S&P 500 has gone through, in fact, an earnings recession already. And it happened over the last 3 quarters, right? We had negative growth in quarter 4, 2022. then quarter 1, 2023, quarter 2, 2023, and this quarter 3, analysts actually expected it to be negative as well. But surprisingly, it has turned positive for the first time in 4 quarters, right? So there we are. The S&P is now reporting year-over-year growth in earnings for the first time since quarter 3 of last year. The blended earnings growth for the third quarter is now at 2.7%, and there are altogether 8 out of 11 sectors that are reporting earnings growth, led by communication services, consumer discretionary, and financials. The 3 sectors that are still reporting a year-on-year decline are energy, materials, and healthcare. So analysts expect earnings growth for quarter 4 this year as well, of 5.3%, which means that essentially the earnings recession is over. We went through an earnings recession over here. We bottomed in quarter 2 last year. Quarter 3, we turned positive, which is this quarter, or rather this now reporting for quarter 3. And then for the last quarter, we expect it to be positive. So now we are in a growth phase of the S&P 500. And for the calendar year 2024 next year, we are expecting an earnings growth of 11.9%. So based on the fact that companies are growing again, it's hard to see another recession. It's hard to see. Again, everything is possible. The war could get out of hand and other shit could happen. You never know, right? But everything else remaining equal, it looks pretty good. The companies are actually doing pretty well. That's why I'm not too worried about this recent drop in the stock market price by looking at the performance of the companies. Now, if you take a look at this chart, you can see, again, the S&P 500 earnings per share, forward and actual. So you can see that the forward are the projections. In red, these are projections. So we have bottom in terms of the earnings and going higher, and the blue is the actual results being reported. So you can see again that inflection point, and we are actually heading higher. Now, what's also interesting is that the US economy seems to be, again, stronger than everyone expected. So quarter 3 GDP just came in 2 days ago at 4.9%, way above expectations. And you can see that it's getting really, really strong. And quarter 4 GDP is now projected at about 2.5%. So with earnings coming better than expected, we have got GDP stronger than expected, we have got job growth stronger than expected. But why is the market going down? What could be the reason? That's something that I think a lot of people are now scratching their heads. So sometimes there may not be a reason. Sometimes the market goes down purely because of manipulation by market makers to flush out the weak retail hands before they run the market up again, those bastards, right? But then again, you could also argue that it could be the 10-year treasury yield. The 10-year treasury yield, kept going up and hit above 5%. So that could have caused the sell-off in the markets. But last few days, the 10-year yield actually pulled back below 5%, and now it's beginning to look like it could be near a top. And inflation data came in, not fantastic, but not terrible as well, right? Inflation still above 3%, but is way down from the highs. And the Fed is not expected to raise interest rates for the rest of the year. So then why is the market going down, right? So there could be a few reasons, right? So my guess could be one reason could be because of tax loss harvesting. This could be one big reason. So remember that in the US, when you sell a stock and you make money, you have to pay tax on the capital gain. But then if you have stocks that are below the purchase price and you sell it for a loss, you lock in the loss, you can use the loss to offset the gains you made on other stocks in order to reduce your taxes. So in the US, a lot of mutual funds, in order to reduce their taxes, they would sell stocks at a loss just to reduce their taxes on the ones they made a gain. We call that tax loss harvesting. But later on, about 30 days later, they'll buy the stock back, or they'll buy a similar stock. So this could explain why some of the stocks that have gone down a lot. For some reason, the last few days, they went down even more because of these mutual funds selling for tax loss harvesting strategy. So to give you an idea, right, for most mutual funds that control, hundreds and millions or billions of stock, the deadline to sell is October 31st, which is another 3 more days. So in other words, we could see another 2 days, Monday and Tuesday, of selling, and once they're done, that's it. The selling stops, and then the selling pressure will abate. That's when the market can rebound again. So this could be one reason. Now, another reason, of course, could be the war that the market is beginning to price in. The war in Israel that seems to be getting worse, right? With now, the US striking Iran, and it could, really, really blow up into a bigger war than people expect. But again, is that something to be worried about as an investor? Again, no one likes wars. Wars are terrible. But if you look back at history, you can see that every single market drop from a war always rebounded even higher, even from World War II, even from the Vietnam War, even from the Gulf War, Afghanistan War, Iraq War, you name it, right? And looking back on hindsight, those times when there was crisis and panic was actually a great opportunity to keep adding shares to high quality companies. Okay? No one likes a crisis, but like there's an old saying, don't let a crisis go to waste. Use it for your advantage, but don't allow it to cause you to panic like everyone else. Now, we are coming to the end of October, and we're going to start November and December very soon. So historically, November and December tends to be a lot more bullish, and especially during a pre-election year, which is this year, and especially during a year that was already up significantly in the first half. So if you take a look at this chart, courtesy of Carson Research, they put up this research chart. You can see that this is the year 2023. We are right now here in this kind of like a correction territory. And if you look at all the past years when the S&P 500 was up more than 10% in the first half, it tended to bottom during this period over here, which is right where we are now, during the late October, early November period. So if, again, seasonality is anything to go by, again, there are no guarantees in this business, right? But based on seasonality, we could be entering a bottom soon in order to ride the year-end rally. So what should you do as an investor and as a trader when you go through such a correction? Well, let's first talk about from an investment perspective. So again, if you are an investor and you're holding on to, again, fundamentally very good companies, don't be concerned about the short-term volatility. Remember that every correction will end. Even if it's a bear market, which is unlikely, every bear market will end and it will soon turn into the next very strong rally or strong rebound. So you want to be there when it happens. You don't want to panic and sell and get out of the markets and the market takes off without you, because it's impossible to predict exactly when it's going to turn. Now, if you still haven't fully allocated your cash and you've got positions that you want to build, again, this is a great time to slowly add on to those positions of high quality companies. Remember, for individual companies, we can never ever predict the exact bottom. You don't have to buy at the bottom to make money. As long as you buy when it is undervalued, below the intrinsic value, and you buy at a support level, and you buy in tranches, you've done your job, right? Over time, you will make a lot of money. So, for example, if you take a look at Google announced good results, right? But the price came down, for all kinds of stupid excuses like, the growth was lower than expected. But their cloud actually turned profitable, right? But use it as an opportunity. So if you look at Google, for example, now roughly, my intrinsic value of Google is about $160+. So now at $122, it is roughly about 27% undervalued. So Google is one of the high quality companies that are undervalued, right? And you can see it is currently at this level over there, right? So is this the bottom? Again, you never know, right? But if you take a look at history, you notice that every time it waves up, waves down, waves up, waves down, waves up, waves down, waves up, waves down, it tends to find support near the 20 EMA, near the red dotted line during these smaller corrective waves. And you can see over here, that's the red dotted line. So you could draw, for example, a support level somewhere around there at about 116. That could be a level of support, right? Now, if it turns out to be a big crash, you can see then the 50 moving average, the blue line, acts as a very, very strong support, which we bounced off. Now, I doubt we're going to go back to the 50, but we may retouch the 20, for example. So if you want to add more Google, then the moment the price, for example, gets near that 20, that could be a region to add shares before the next wave up pattern, right? So that's what you should do as an investor. Now, if you are a trader, should you be buying any stocks right now? No, right? Because the market's on a short-term downtrend. So in trading, you want to ride the short-term trend. When the market's on a downtrend, you don't want to be buying, going long. In fact, you want to be going short on a downtrend when the market rallies to level of resistance. So, for example, if we go down to the daily candles, let's take a closer look at the daily candles. You can see, we are in a short-term downtrend because the 20 EMA, the red dotted line, is below the 40 EMA, and the price is below the 50 moving average on daily candles. So we are on a short-term downtrend over there, right? We've got a wave up, wave down, wave up, wave down, wave up, wave down. So it's making lower highs and lower lows into this downtrend channel. So again, you don't want to be buying anything until the downtrend reverses into an uptrend. And you got to be patient and wait for that to happen before you start buying again, okay? And if you already bought things before this downtrend, it may have hit your stop loss. You just get out and wait for the next opportune uptrend pattern, yeah? And of course, you may say, could I short the market right now? Yeah, you can short the market on a short-term basis, but I wouldn't short over here, right? Because what happens after a wave down, right? If you short over there, then the market may wave up and you get screwed. And so the safest time to short is after wave up. If it hits that resistance level, it can break that resistance level, then you do a short over there, buy some put options and catch the next wave down to the next level of support. So remember, whether you are an investor or trader, the key to success is not predicting exactly where the market is going, because no one can predict. It's all about looking at the current price action as a trader. Price action is on an uptrend, you want to go long. Price action on a downtrend, you want to go short. Have your stop losses and profit targets in place. Risk $1 to make $2 and do that consistently. As an investor, it's all about following your investment plan, looking at the individual companies. As long as the companies you own are fundamentally solid, they are producing more and more revenue and profits, you have no worries, right? Short-term volatility, market goes down, ignore it or use it as an opportunity to add more shares. If you don't already have a full position, be patient and you will do really, really well. So we have got the last 2 months left for the year. I'm as curious as you are how we'll end the year off, but I'm still hopeful that even though prices may still go down for another 1 or 2 more days for the next level of support, I think that the seasonality should kick in this pre-election year, and we should see a rally by the end of the year to end up higher than where we are right now. So thank you for listening, and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.